Kick off. So, welcome to you all to what is actually our first of a series of 5 webinars, which we're hosting as a tax assurance and risk management team, all on the theme of navigating the changing landscape of tax governance. And today we're delighted to kick off with part one, which is all about what it means to be a large business in terms of tax governance and control, and why it matters, and actually why it's valuable to you. So, by way of background, my name is James Egert. I lead up our national tax assurance and risk management team, and I'll explain what that means in just a moment. And absolutely delighted to be joined by a great group of speakers today. So, Natalie, if we can move to the next slide. So we have Karen Riley, who's a partner in our TARM group, who will be providing some context of what we mean by governance and what we mean by what it takes to be a leading business or a big business. We've got Martin Jackson, who's a director in our team. We'll look at some of the technical detail. Delighted to have Simon, who will be talking about some of the aspects of guidelines for compliance and asking and answering some questions on that. And very, very pleased to have a guest speaker, Shane Murphy, Head of Tax at Value Foods, which is going to give us a client's perspective. So thank you to you all in advance. So on the next slide. So just to give you a heads up, and this will be mentioned a bit later on, this is indeed the first of a series of 5 webinars that we're hosting over the next 6 to 8 months. You will receive lots of invites for this, I'm sure, over the coming weeks and months. But a date for your diary, first of all, is the one that we're doing on the 5th of February, which is all about building your tax operating model or tax control framework, thinking about what good governance means holistically, both from a UK's perspective and actually on a global perspective as well. So we're going to be bringing in some of our global colleagues and thinking about it from a worldwide perspective. But you'll hear more about that later on. Okay, now I did say we're part of the tax assurance and risk management team, so let me explain to you what that means. So we are a group of about 20 people at BDO. Karen and Martin are both part of the team. And essentially the way that I like to think about it is we think about the operations of tax. Our job is essentially to work with you, whether or not you're in the tax team or in the finance team, to provide a culture of no surprises when it comes to how you manage your tax operations within the business, to provide assurance and transparency over your tax controls and processes. And that's the purpose of these 5 webinars, to think about it from that perspective. So for us, when we work with our clients, what we try and provide is that peace of mind, assurance that your tax is operating effectively, which also means efficiencies as well. And we do think about this from a process and people perspective, as well as technology. And so we'll be looking at that over the next series of webinars. But that's probably enough. I think we need to get down to business today. So Karen, I'm going to hand over to you, please, to go through the agenda and kick us off. Thank you.
Great, thanks very much. So on our agenda today, James has already introduced the session and has set the scene. So we'll then be briefly next looking at the context for tax assurance. Then we're going to look at what are almost 2 ends of the assurance spectrum, legislative and strategic assurance, and what these mean. We're then going to run through the current governance-related compliance requirements and the key expectations to help you manage your tax obligations effectively and to help you develop your tax operations in the process of doing so. Please do feel free to ask questions as we go along. Be really grateful though if you could use the specific Q&A function that you could see at the bottom of your Zoom screen rather than the chat function. The Q&A function tends to work best, so that would be great, thanks. So let's dive in. Next slide, please. And the next one. Great, thanks. So we're going to start off with a mini tax history lesson. So for many years, I think it's fair to say HMRC have been interested in tax governance, and I think also the compliance requirements and the expectations in relation to how these are demonstrated and evidenced is only increasing. So the slide here that you can see shows a bit of a potted history of governance and systems related compliance requirements, starting back with the original business risk review in 2007. The SAO regime followed 2 years later in 2009. We then had a brief period before there was then a flurry of new provisions, including the requirement to publish a tax strategy in 2016, then the corporate criminal offences legislation the next year, followed soon after by the enhanced business risk review framework, which we're going to touch on in particular detail today in 2019. Then the uncertain tax treatment notification requirement followed in 2021. And since then, what we've seen is HMRC publishing 10 new guidelines for compliance. And most recently, we've also had the new failure to prevent fraud offence guidance, which has some overlap with tax governance as well. Now, all of these sit across and interact with various different taxes. And then in addition, you've got some specific provisions which also have underlying need for good governance and systems, such as the reformed IR35 rules, making tax digital for VAT, Pillar 2, etc. So I think when you stand back from this, you can see here that there's a clear direction of travel in relation to tax governance, and we don't expect this to change. And whilst these are HMRC-led obligations, there are benefits for businesses when they're addressed well. Next slide, please. So we think it's useful to think about tax assurance as either legislative or strategic. So on the legislative side there, you've got the Senior Accounting Officer regime, or SAO, the Corporate Criminal Offences regime, or CCO, the Uncertain Tax Treatments, UTT, and the Tax Strategy Publication requirement. Now, we'll try to use the abbreviations throughout the session today. These are all things that are driven by legislation, which, if in scope, means businesses have to respond to in some way. There's a necessary action, a submission, or a publication needed where there are, in some cases, quite hefty penalties for non-compliance. But all of these things ultimately drive good tax behaviours. And then on the other side, you've got strategic tax assurance, which is all about the proactive and voluntary actions that businesses can take to support and demonstrate the legislative side, but overall strengthen tax operations as well. And so sitting in between, you've got HMRC's enhanced business risk review framework and the new and evolving guidelines for compliance that are being published in succession, which tend to push businesses beyond trying to simply meet the minimum legislative requirements and into the strategic space, because HMRC's expectations are high. And so we're going to focus on the legislative provisions first, where we'll run through each of them and recap on what they are, because we're conscious that on the call we've got people who are growing into this space and we've got businesses who are already there. So we'll run through each and recap on what they are, but most importantly, we'll then think about what the expectations are in terms of your response as a large business and the practical strategies for delivering on this. So I'm going to hand over to Martin to start us off on these.
Thank you very much, Karen, and thanks very much for joining, everyone. Yes, I'm going to take us through a couple of the legislative requirements and attempt to demystify those for you on the call today. If we go to the next slide, please. I want to first of all touch on the Senior Accounting Officer, or SAO, requirements. So these are applicable to businesses in the UK, so UK incorporated companies or groups of companies with turnover in excess of 200 million or balance sheet assets of 2 billion. Some of you may be familiar with these requirements already, so hopefully this provides a helpful recap. Others may be something that you are looking towards very shortly or sort of in the near term, and hopefully try to outline what it might mean in practice whenever you are within the SAO regime. So effectively, organizations who fall within this are deemed to have a senior accounting officer, so an individual who ultimately has accountability over the tax accounting arrangements of that organization. In practice, that senior accounting officer, they have a main duty to take reasonable steps to ensure that they establish and maintain appropriate tax accounting arrangements. The types of taxes in scope you'll see on screen there. I'm not going to regurgitate all of those, but for most organizations, it will be things such as corporation tax, VAT, employment taxes, and perhaps customs. what that SAO is required to do on an annual basis is provide HMRC with a certificate attesting to whether they had appropriate tax accounting arrangements or otherwise in that period. So they have to state to HMRC that, yes, I, as the SAO, met that main duty requirement. Now, there's a few other things that need to be done there. So, first of all, the certificate needs to be submitted by the SAO and signed off by the SAO. A notification also has to come from the company outlining who the SAO was in a particular period. Now, there are certain penalties for failure to comply with that. Notification penalty would be on the company for failing to provide that document. However, the SEO can be personally liable if either they didn't provide a certificate or if they were deemed to breach that main duty. If we go on to the next slide, please, I think it's helpful to outline what HMRC's expectations are for organizations who fall within that regime, and in particular on the SAOs and what their role is. So I mentioned on the previous slides that the senior accounting officer has to maintain appropriate tax accounting arrangements. And what that means in practice really is we can sort of garner some insight from HMRC's commentary on this. So there's plenty of guidance, plenty of commentary over the years since it was introduced. But effectively, they're expecting senior accounting officers to have tax governance procedures and arrangements within the organization, which are properly communicated to those involved, that they have guidance and control framework where we've got roles and responsibilities for tax clearly defined in the organization. So we know what our key processes are, we know who have oversight of those, and that there's a framework of compliance around that where the SEO can obtain assurance that those are working effectively. So HMRC would require senior accounting officers to monitor their tax risks throughout the year, identify whether there's any deficiencies in those, and that should inform the certificate position. Now, we talk about tax governance. What tax governance means within an organization is looking at a number of different aspects: your risk management framework, the capability and the resource of the teams, the technology that you use to ensure that you've established those appropriate tax accounting arrangements. Importantly for SAO, HMRC say that whilst you have established that, how do you ensure it works in practice? So another aspect that HMRC would require of SAOs is to ensure that they have some form of risk-based testing to be able to establish that those processes are working as intended in practice. So if we go on to the next slide, I just want to maybe bring to life a little bit what organizations need to do fundamentally in order to comply with these requirements. So the senior accounting officer should identify the entities within their remit within the organization. Now, ultimately, there can, depending on the way that business is set up, we can have sort of centralized or decentralized models. So it could be the case that an SEO ultimately has accountability, but there may be certain responsibilities that are sitting on a divisionalized level. Perhaps it could be certain entities have different processes in place, and perhaps there's a lack of consistency. So the senior accounting officer in being able to provide that certificate to HMRC will need to work with relevant stakeholders in the organization to understand the processes, understand how those were applied throughout the year, linking back to that point around risk-based testing, reviewing the processes, and working with stakeholders in the organization to assess the appropriateness of those. Now, in doing so, it's important that that is properly evidenced. So what we would suggest for businesses is that you need to develop a compliance framework around this so that you're able to substantiate the certificate position. So, for example, On the right-hand side, we have an overview of what we have established at BDO, which is an established methodology to assess the appropriateness of tax accounting arrangements of a business and sort of benchmark those accordingly. So we know what's working well, we can see what's not working so well, and thus can provide some recommendations for where we can make those improvements and thus provide assurance to the SAO before they submit the certificate to HMRC. Next slide, please. So another requirement that comes into play once we sort of hit those size requirements for organizations is the requirement to publish a tax strategy. So this is something that would be publicly available either on your website or within your financial statements. And it needs to comment on a sort of a number of areas that you'll see on the right-hand side. But importantly, because it is a public document, we would always recommend that businesses take steps to ensure that any published statements on tax on their website align with wider publications that they might have on, for instance, ethical principles, codes of conduct, and so on. So that's an important point to take away here to maybe differentiate that from your peers, perhaps. Now, organizations need to publish that every year in which it applies, and there are penalties for failing to do so, which you see in the bottom of the screen there. So it's important that businesses take steps to ensure that that is published and that they are properly capturing the Finance Act requirements, but also HMRC guidance on tax strategies. Next slide, please. So, looking at another legislative requirement. Now, this one isn't necessarily applicable only to large businesses. In fact, it is applicable to all businesses. But ultimately, once an organization is within that SAO regime, there can be an additional sort of spotlight on what they're doing or something like the corporate criminal offences. And indeed, there is a little bit of crossover because ultimately this will be looking at your processes and controls and how you're monitoring your risks. So CCO was introduced in 2017, and effectively it provides for a criminal offence for an organisation for failing to prevent facilitation of tax evasion by its associated persons. So that would be its third parties, its suppliers, its employees, contractors, etc. So organizations need to take positive steps to demonstrate reasonable prevention procedures. So in practice, what could happen if an organization would be prosecuted under this? It could be subject to unlimited financial penalties, public record of conviction, and potential reputational damage. What HMRC have tried to do by bringing this in is actually ensuring that organizations bring about a cultural change in terms of how they view tax evasion and facilitation of tax evasion within the organization. So if we come on to the next slide, I just want to, again, just touch some of the practical aspects of what businesses can do to put a defense in place. Now, this is very much, in a way, modeled on the Bribery Act. So those of you on this call might be familiar with that, and a lot of these principles will be very similar. Now, there's sort of 6 guiding principles of a defense, but we try to break these down into sort of 3 buckets. So the first of which is undertaking a risk assessment. So understanding where there is potential for facilitation of tax evasion to occur in your business and making sure that that risk assessment is documented. So that could be perhaps looking at areas such as HR, it could be looking at procurement, it could be looking at accounts payable, and understanding what controls you have in place to mitigate those risks. The sort of second bucket, as we call it, is around the policies and procedures to embed that zero tolerance culture to facilitation of tax evasion in your business. And that's ensuring that you have, for instance, a CCO policy, the same way you might have an anti-bribery and corruption policy. It's looking at your procedures around due diligence. It's looking at your contractual wording, what's in your supplier code of conduct, for example. And the sort of third bucket is around training. So ultimately, if we're looking at potential risks, ultimately it comes down to those individuals on the ground who are seeing transactions firsthand and ensuring that they have the knowledge to be able to identify any red flags and escalate those up as appropriate so that they can be managed and dealt with. Now, I just want to probably provide a couple of quick updates in CCO, but actually, Karen, you recently had a call with HMRC's CCO policy lead, and I'm just wondering whether you can maybe provide the attendees with some insights from that call.
Yeah, sure. So it was a really, really insightful call, actually. It was great to be able to have the access to the CCO policy lead there. So there's a few key updates to share on this. So I know HMRC have been indicating for some time that they are getting closer to prosecution, and I think there's been a significant number of cases that have been reviewed and where it's been determined to not be in the public interest to pursue. But HMRC are very confident, it seems, that they have now identified the first cases that are likely to result in prosecution. I think one of the really interesting takeaways is that there's a growing number of large businesses within the pool of cases under active review currently, which I think is a movement certainly from 12 months ago when we had the last update from HMRC. I think one of the other interesting developments is there seems to be a bit of a shift in expectations as part of business risk reviews. Previously, we'd had messages from HMRC that they wouldn't ordinarily expect to be asking businesses to share CCO-related documentation because they didn't want to risk there being an implied approval or assurance that they were meeting that reasonable prevention procedures benchmark. But I think because we're going to come on to this actually, how the business risk reviews have evolved and moved on, and HMRC is more increasingly seeking evidence rather than confirmations that responses and can be demonstrated. HMRC is now asking in some cases for CCO documentation and risk assessments to be shared. So I think there's a key point there for businesses to ask themselves around, are they currently comfortable that their CCO response and risk assessments, etc., or summaries thereof would be in a suitable up-to-date state to share with HMRC? I think the other really recent development, though, which interlinks with the conversation with HMRC, is that the new Economic Crime and Corporate Transparency Act and the failure to prevent fraud offence, the guidance on the failure to prevent fraud offence was published a month or so ago, and HMRC seemingly have been quite involved in how that guidance has been developed, and it certainly seems that they are thinking and reflecting on the path that CCO has followed, and you can see some of that being reflected in the guidance. Now, whilst the two are very, very separate, distinct offences, each requiring their own response, what HMRC has said is that they do expect the failure to prevent fraud guidance to really magnify and reinforce CCO, and for it to act as a driver for businesses to refresh their CCO risk assessments. And in particular, HMRC, it's the first time really we've had the clarity from them, but they gave a very clear expectation that they think businesses should be revisiting and refreshing their CCO risk assessments annually as a minimum every 2 years. So it's clear that there is an expectation there that CCO should be back on the agenda if it's been one of those areas that's dropped off in recent times. Shall we move on to the next slide, please? Okay, so we're going to move on now to the uncertain tax treatments, or UTT. So this one is a formal requirement to notify HMRC of uncertain tax treatments. Here, HMRC is aiming for early identification of tax uncertainties. And a bit like SAO, it applies to large businesses. So where the 200 million turnover or 2 billion assets thresholds are breached, but it applies to partnerships as well as companies wherever they're formed. So it also can apply to UK resident companies and UK permanent establishments of overseas entities as well. Now, uncertainty is measured by reference to two triggers just there on the right of the screen. So the first one is that there's provision in the accounts to reflect the probability that a different tax treatment might apply, or the tax position relies on an application or interpretation of law that differs to HMRC's known position. For example, a position that's set out in such as the HMRC manuals and including the new guidelines for compliance, which we'll come on to as well. It effectively applies to corporation tax, VAT, and partnership returns, and certain returns under the pay-as-you-earn regulations where there is a tax advantage that exceeds a 5 million threshold. That sounds like a lot, but it's not really for some of the operational taxes like VAT. There is a general exemption available on this one where it's reasonable to assume that HMRC have all the information that would otherwise be required in a formal notification. But I think this one's quite a complex piece of legislation, and in my experience, achieving the general exemption is quite a high bar that most businesses won't meet unless there have been in-depth and documented discussions with HMRC. And also, it is complex and there is some care needed around the filing deadlines because they differ depending on the type of return that the uncertainty relates to, because there are material penalties for non-compliance, such as non-submission, late, incomplete or inaccurate notifications, where penalties can be 5, 20, 50k on a first, second, third failure basis. So care is needed on this one. And I think it's fair to say that HMRC have faced a bit of challenge at points in the past on the effectiveness of this policy, because relatively low numbers of notifications have been made to date. But against this, the notifications which have been made have far surpassed HMRC's initial expectations in terms of the tax that's been identified as being uncertain, which, based on the published statistics to date, stands at over 600 million. I think as well, the resulting compliance activity is a little bit unclear at this stage. I think there will be lead time before we really see what that looks like, but it is a feature of business risk reviews. So you do need to be able, if you're in scope, to demonstrate compliance, even if the answer is ultimately that you don't have a formal notification to make. The other point to make is that the legislation is soon going to be subject to an evaluation. So we'll see if it moves on or evolves at all. And interestingly, pre-election, Labour published a plan to reduce the tax gap, and there was suggestion in there of widening the scope of tax arrangements to be reported under the DOTAS framework. So it might, that's my personal thoughts on it. It's a little bit speculative, but I do wonder if we might see some change under a new government. But either way, we do have to live with it for now. And like I say, in my experience, this is one of the legislative requirements that it's complicated. And I do think that businesses have perhaps found it a bit conceptually harder to address, given that most businesses are generally trying to be compliant. So if we move on to the next slide, where we can think about some practical approaches. Can we go on to the next slide, please, Natalie? Brilliant, thanks. So it's important that alongside your compliance processes, you find a way to build in consideration of UTT. And really what that means is teams who input into tax processes need to have some awareness of these provisions, and the governance structure needs to be in place for teams to escalate to the right people at the right time to meet the compliance requirements. And a few practical questions you might ask yourself on this are, first of all, who's responsible in the business for UTT? Does it need to feature in your tax policy or other policies or any internal process documentation to ensure that this one gets considered? Do you know which of your returns are in scope, and are you familiar with what the deadlines are in case there might be a need to notify? How are you going to monitor and even identify potential transactions or arrangements which might fall in scope, might need considering for UTT? And when preparing and filing returns, have you got a process for considering UTT? Have you got any documentation, or what kind of documentation do you have to evidence that you've considered it, even if, as I say, the outcome is that no notifications ultimately needed? I think these are just a few key questions to address to ensure that you've got some kind of structure in place, but ultimately I'd be looking for some documentation and evidence to demonstrate the strong compliance that HMRC expects. Next slide, please. So moving on next to the guidelines for compliance, we'll refer to this as the GFC. So these were announced in late 2021 as part of HMRC's review of tax administration for large businesses. And essentially they're a suite of products for use by businesses and advisors to inform their approach to tax compliance. And the goal here is to extend public information beyond HMRC's interpretation of the law, which we see in HMRC's published manuals, to go a step further to help businesses understand HMRC's practical expectations to support and mitigate reducing tax risk. So in simple terms, they explain HMRC's view on complex, misunderstood, novel risks that are emerging to help businesses mitigate the risk of non-compliance. And they apply to any duty or tax that HMRC administers. And you can see on the right-hand side there that so far today, HMRC's published 10. We're a bit unclear at this stage on how many more might follow. We could be looking at just a handful more. We could be looking at many, many more. But ultimately, these don't replace the manuals, which are HMRC's view of the law still. Rather, they sit alongside and provide more insight, for example, sharing common errors where HMRC thinks that that might help businesses to be more compliant. It's important to note as well that they're not a safe harbour as such. It's not a case of follow these guidelines and you'll be compliant. Following them in principle should reduce tax risk and help you to be compliant, but businesses do remain responsible for their self-assessments. I think it's also worth noting that a number of the guidelines cross-reference SAO, which Martin spoke about before, particularly the VAT controls and the recent transfer pricing GFC, where there's very much a focus on practical checks and controls, some of which can be lifted and built into checklists, which can support how you align with these GFC. But fundamentally, they are of value where businesses would benefit from a practical path to follow that follows in line with HMRC's view of the law. They're optional. They do specifically say you don't have to follow them, but given the growing expectations and given the growing governance requirements, particularly for large businesses, you'd have to stand back and question why you wouldn't have regard to them. But note as well, they're not just for large businesses. So our sense is that this will push some of those governance expectations and good tax behaviour expectations into the mid-sized business space. But I think it's certainly one, if you're growing into this large business space, it's worth having an eye on them. And so in summary, the GFC, I think, add to and reinforce the tax governance direction of travel. And there's been a real upskilling within HMRC and the CCM population of what good looks like. And that's now being reflected back to businesses through business risk reviews and through publications of these GFC. I think for those businesses that are already in the large business space and are within the SAO compliance regime or have business risk review expectations, there's a key point there around having a sense check of whether or not you're currently aligning with these GFC best practice. I think one of the dangers of the GFC is that, inevitably errors and issues can crop up and businesses might need to occasionally make corrections. But I think it would be an easy question from HMRC to ask in terms of, have we followed these guidelines and therefore have we demonstrated reasonable care? So moving on to the next slide, please. So the business risk review, the BRR, we've mentioned this one a few times in the session already. So just to briefly recap on what the BRR is, it's HMRC's way of formally risk assessing large businesses by reference to 24 low risk indicators, which fall under 3 headings: systems and delivery, tax governance, and the approach to tax compliance. So depending on the extent to which businesses can demonstrate these indicators, they'll either be assessed as low risk, moderate to high, or high risk, which in turn informs how closely HMRC monitors and carries out compliance activity. Next slide, please. Thanks. So in our experience, the approach to business risk reviews over the last 18 months or so has really moved on and developed, and the preparation needed to meet HMRC's expectations and to support a lower risk rating, we think, has increased. And all of the areas that Martin and I have covered so far are inherent in the indicators that HMRC benchmark against. And so HMRC will, through a BRR, ask about how the business has responded to each of these. And it's likely that they'll ask for evidence of that too. Now, we think HMRC will soon be asking businesses as well, have they read and understood the GFC? We're aware that HMRC has raised the GFC with some businesses already, particularly the VAT and the transfer pricing ones. So it feels like it's a natural next step for this to become part of the business risk reviews. If you remember when UTT was introduced, it wasn't long before it became a specific part of the low risk indicators. And I suspect that this will follow in the not too distant future. We're also seeing HMRC still issuing quite detailed questionnaires, but it does feel like the scope of questions is growing in advance and as part of that readiness for business risk reviews. So for example, we're seeing BRR questionnaires on such as software, systems and data, the profile of tax and finance teams and reporting lines and governance, for details of tax policies and documented tax processes and for copies of those, whether businesses have tax risk registers in place and can they share them with HMRC. We're also seeing BRRs asking for details of the approach to SAO compliance, and more recently HMRC, I would say, have definitely shown more interested in actually understanding not just the monitoring part of SAO, but the actual assurance checks, the testing component, the extent to which checks are taking place annually to ensure that tax processes are working as intended and are delivering materially accurate tax outcomes. We're seeing HMRC ask about how tax knowledge is maintained. And I think in our experience, that can be one of the easy, we've all been doing this a long time, right? We all know what we're doing. People are established in their roles, but actually maintaining up-to-date tax knowledge is really quite key in all of this. We're also seeing questionnaires, particularly in depth, about the depth of CCO response to date. But we're also now starting to see specific questions coming through on specific areas of tax compliance, such as non-resident directors, global mobility, customs procedures, IR35 compliance. And when you think about all of that, the information, the extent of it that HMRC is asking for, it's really interesting that HMRC's yield from large businesses has increased quite significantly since the enhanced business risk review framework came into play in 2019. I think it's quite difficult to deny that BRRs are actually quite productive, and you can't lose sight of the fact that whilst they are a collaborative process with HMRC, they are essentially compliance activity that businesses need to be ready for. So our recommendation here is that if you have a business risk review coming up, or you think you might be assigned a CCM in the not too distant future where you'll be brought into this framework, plan your readiness and think about the areas which might need updating, or where you might have gaps to fill that might need to form part of your tax agenda for the short to medium term. And so from all of this, it's really clear to me that HMRC's expectations for those businesses that want to be treated as lower risk, to be treated as trusted taxpayers, are going to need to go beyond the legislative requirements and into that strategic space, which we're going to move on to next. Can we have the next slide, please? Natalie, are you able to move on to the next slide, please?
I think I'm next up, am I?
I've just got one next bit, Shane. For some reason, the slide hasn't moved on. Oh, there we go.
Right,
It's moved on now. Right. Perfect. So we'll just be a couple of minutes. Natalie, could you just hop back a slide or two onto the strategic slide, please? So I was just going to touch on strategic. We're going to start with the definition of a tax control framework, which the OECD defines as the part of the system of internal control that assures the accuracy and completeness of tax returns and disclosures. Now, interestingly, tax authorities and regulators are expecting businesses to have considered that definition and demonstrate the steps that they've taken to develop a roadmap, which sets out the steps to improve how tax operates or to build on what's already in place. So typically, wherever a business is looking to start developing or refresh their tax governance, the first step usually is to understand the current status of tax operations through a maturity assessment. And this is something that we support businesses with. This is often the best starting point where you're looking to develop and strengthen the tax operating model to ensure that you get the best return on your time and investment. And then next, it's about developing an overarching tax policy, which sets out the expected standards of conduct in relation to tax, including RACI analysis, which looks at who is responsible, who's accountable, who controls, and who needs to be informed across all aspects of your taxes. And it's the tax policy that drives how you achieve your published tax strategy in practice. So supporting your tax policy is then a series of documented tax process notes for your key tax processes. Next, it's then about developing a tax risk management framework, which is usually through tax risk and control matrices to actively identify, manage and monitor tax risk, which should support SAO compliance depending on your approach. And we'll maybe touch on tax risk registers later, but all of this needs to be supported by adequate systems and accurate data and means of maintaining relevant tax knowledge in the business. Then there needs to be a means of ongoing monitoring and review. Now, businesses will inevitably be at different stages of maturity, but this roadmap approach can be applied at any stage, either to develop from a zero starting point or for those looking to refresh and test what's in place. So we thought at this stage it'd be really helpful to introduce Shane. As James mentioned before, he's the head of tax at the Valio Foods Group. He's going to share some practice insights on tax assurance. Shane, are you able to come on?
I am.
Hi there.
Hold on.
Perfect.
Turn my camera back on. Yes.
Oh, it's great to have you here today. Thank you so much for joining us. Perhaps you can introduce yourself and tell us a little bit about your role and your thoughts on what we've talked about so far today.
Yeah. Hi everyone. So Shane Murphy is my name. So I'm the group head of tax in a business called Valio Foods. So look, I've worked with Karen and some of the guys on this call over a number of years on a bunch of stuff, but certainly on some of the areas that have been touched on this morning. So I suppose, yeah, the business I work in, look, it's I suppose a medium-sized business. We're private equity backed, so we're owned by Bain Capital. We're kind of a 1.6 billion, 1.7 billion euro turnover business, about 160 million EBITDA. Just in terms of the size and scale of our business, we effectively we're in the what you might call the ambient food space, which is a fairly broad kind of catch-all of stuff, but I suppose predominantly in kind of sweets and snacks, effectively. Predominantly across Europe, but we have a bit of a presence in North America as well. Um, for those of you in kind of UK based, look, our kind of probably some of our big brands in the UK are, I suppose, Rouse Honey. We have a large honey business, Kettle Crisps, Barrett's kind of sweets and confectionery and all that kind of stuff. And we do a lot of kind of private label products as well. So it's not just the branded stuff that you'll see in the shops. A lot of the private label stuff is ultimately coming from us. Um, so yeah, look, I suppose that's kind of the business that I'm in. I know probably a lot of you there, obviously from a lot of other varying businesses. So I think yeah, the business that you're in can somehow kind of, I guess, kind of color your approach to some of this. I think as well. I think if I talk, I'm going to maybe the next slide because that's only just a cover slide. I think how we do tax, if I want to call it that, is probably it's not unique, but it is probably different from some of you guys on the call today. Like our business has grown. Like our business was effectively formed back in 2010 through a merger of a couple of Irish businesses, and you can also tell by my accent probably where I'm from. And we've grown, I suppose, since then predominantly through M&A, expanding our footprint into the UK, into mainland Europe, and over into North America. And I suppose our model generally is we're quite decentralized, or historically, I'd say we've been quite decentralized in how we've done things, and obviously by extension, that extends to tax then as well. I'd say we're probably going on a bit of a journey where that is changing, and certain things are becoming more centralized as a business as we grow. There's just a natural evolution there ultimately. Um, but typically, look, we've a very small kind of, would say, group or head office tax team, and then that's effectively supplemented by our divisional finance teams who will essentially deal with a lot more of the, would say, routine day-to-day kind of compliance type matters, be it payroll, VAT, certain elements of corporate tax as well, compliance locally, and then the more strategic stuff is typically within the remit of the group tax team. Um, if I think about then, how that extends to this whole area of tax governance and tax assurance. As I said, kind of historically, our model has been, decentralized. And I suppose that tax governance piece has effectively been decentralized historically. Like I probably should have said at the start, I've been in the business now coming up on 4 years, and I guess when I joined the business, there wasn't any framework or anything of note really within the business, in terms of just documented processes around how do we manage tax, how do we do tax, in terms of the basic bread and butter compliance, but more generally this area of what controls do we have in place to manage tax. Um, and I would say since I've been in the business, there's been a change of owner, in terms of, we were sold by one private equity house, Capvest, to another, Bain. And I think with that change of ownership, there has been that step change in terms of how we approach a lot of things across the business, and that journey to centralize certain things. And I think that in turn has then, kind of pushed us to be a bit more structured in terms of how we think about governance around tax. I guess clearly, look, there are specific requirements here in the UK that, be it on SAO, CCO, and some of the other areas that we have to be compliant with ultimately, and it's not you know regardless of what we do in our business. And I think that has been probably, I don't know, kind of maybe jumping ahead to the kind of the challenges here, but that has been kind of a big challenge for us in the business is um doing this, I suppose, in hand in glove with the business. Like certainly, when we've approached kind of governance, initially when I came into the business, I think there was certainly a focus on making sure we were getting comfortable around complying, say, with SAO and some of the other requirements. But I think now we're very much focused on, in conjunction with kind of wider policies we've been rolling off across the group, how we deal with tax governance across the group and not solely focused on, say, the UK SAO piece or CCO or anything else, say UK specific, which clearly is very important. Like if I think about the UK requirements specifically, and how we've kind of addressed or managed those, like I think, like I alluded to when I came into the business, there wasn't much there in terms of real structure. Um, and I think, certainly the management, I guess, that probably was in the business when I started at the time, didn't have a huge interest in this area, in all honesty. And I think, look, obviously with people changing in the business, it's been a bit of an easier uh, subject to get buy-in across the business, because I think one of the things when you're thinking about tax controls and the processes, especially in a decentralized business, is ultimately needing buy-in from teams to manage that, and because they're the ones who are going to be living, the day-to-day management of how do you do VAT, how do you do customs, how do you manage IR 35, for example, and these other areas that, look, when you're a small group tax team, clearly you're not going to be in the weeds of on a day-to-day basis. Um, but I think there has been, yeah, certainly, with changing of team, with changing of shareholder, that has helped us kind of get more buy-in, I'd say, across the business around putting in place kind of clearer processes and clearer controls. I'd say it's certainly not a finished product by any stretch. Like these things are always very much a work in progress. But I think, you know what we've done so far, as I said, is we've kind of, you know we've tried to get the basic building blocks in place. I think that's always the challenge here with this. Like certainly when I came into the business, it's sometimes maybe you naively kind of have that the gold standard kind of view of the world in your mind's eye. And I think getting there is sometimes easier said than done when you need buy-in from a lot of stakeholders. Um, but I think, yeah, like what we've done, kind of, as I said, on SAO to date is, we've done a piece of work ourselves. We've gotten kind of periodic reviews, say, from Karen and the team on certain parts of our UK business. Um, and we are, I suppose, as a business, kind of building out an IA function, and there's a little bit of how we're, say, thinking about SEO, how we're thinking about CCO and some of these other areas. It loops into the wider internal audit discussion that we're kind of having. And I think how we approach this is evolving in the business. Like I think kind of getting to that gold standard of the all singing, all dancing, um, robust tax control framework, and something that's, frequently tested. Like I'll be honest enough and say, look, that's not where we are as a business yet. I'd like us to be there right now, but that isn't quite where we're at the moment, and it is very much a journey. And I think one you kind of have to be when you have to be patient with. Um,
Would it be fair, Shane, to say that
Mm.
you've broadly started on your journey in line with that roadmap? I mean, I'm aware that you've got your
Yeah,
policy in place, you've
yeah,
got your teams lined up to engage with this, you're thinking about who your stakeholders are internally, you are
yeah,
thinking about SEO compliance and CCO compliance, and
yeah.
it sounds like you've had a bit of an open door in terms of the expectations and desires from new ownership. So your stakeholders are coming at this from a different perspective, but
Yeah.
you've referred to that decentralized model.
Mm,
Have
mm.
you how have you found it in terms of engaging the individual businesses with this journey?
It varies. I think it kind of depends on the personalities. Is kind of probably
Yeah.
the short answer to that, Karen. Like some people, some people are quite mature in their outlook, I suppose, and they get it. They might have come from, say, maybe larger businesses or listed businesses where this is obviously a lot more maybe embedded.
Mm.
Um, but then equally, look, there are other parts of our business where you know yeah, it can be seen as a chore, I guess, if I kind of put it
Yeah.
in that kind of terms, especially, something like that where people will some will take the view, well, look, I follow my returns on time, I pay my tax, we're trying to run a business or a division here, you know, this just feels like a lot of hassle. And that is that can be a challenge when you get a little bit of resistance on that sometimes. So
Mm.
yeah, you do need it can be hard to bring people on a journey, and I think like certainly my view on this, look, this is something that has to be collaborative, I guess. Like you kind of have to bring people with you, and it's not easy sometimes. But it's certainly not something you can kind of go, well, this is a group initiative or something we're kind of forcing on you, especially
Yeah.
when it's if you think about it from a divisional finance point of view, like when they're commercially focused and focused on EBITDA or, performance of the business, this kind of stuff, it's a harder sell, even though, look, ultimately, if you get your controls wrong, there can be a knock-on impact in terms of tax liabilities, filing return. There is an obvious kind of correlation there, but it's kind of for a
Yeah.
lot of, or for some people, I should say, it's not quite top of the pecking order, I guess, in terms of just
Yeah.
being commercial, and you have to appreciate that as well. So
I think
it's
perhaps
yeah. Sorry, go on.
so sorry, go ahead.
No, so I was going to say, look, so it is a challenge to yeah to bring, but you just kind of have to invest the time, I guess,
Yeah.
to really and in a lot of cases, again, depending on the personalities involved, I guess you, there's a bit of a no makes people tick and knowing how you can help them, I guess,
Yeah.
and so it doesn't feel like a burden, or it's not intrusive to them.
Yeah. Okay, so one quick question.
Mm,
So, point you mentioned there about helping the businesses in your group.
yeah.
So one quick final question before we open up to Simon for Q&A is, do you feel like you've seen value from the approach you've taken so far to invest in governance?
Yes, I think is the short answer. Like if I pick a simple example, like we had a customs audit in the UK there earlier this year, and ultimately came out no issues, and you say great, box ticked. But the guys who were getting into the weeds of that and dealing with that process, it did very much kind of show up well in getting all the various answers for HMRC around that. It was a massive chore, a massive pain, and I suppose it did kind of bring to light that kind of example of, well, how good are our controls around, especially say something like customs where it's probably a bit of a bugbear of mine, but it's always a bit of a blind spot, I think, for a lot of
Yeah,
businesses. It doesn't really sit with tax, doesn't really sit with
yeah,
finance. That's kind of the procurement guys, isn't it? So it's one of those ones that can kind of fall between a few stools in some businesses,
yeah, I think that's
and
fair.
I'd say that's somewhat true of our business. Again, being very honest, you know, but it did very much kind of just kind of in a very live way bring out, okay, yeah, ultimately no issues and no exposure there, but the hassle of just getting comfort around that and getting clarity around that, and also kind of realizing, well, yeah, like in certain parts the process isn't maybe as good as we might have blindly assumed.
Mm,
So it's those kind of things that I'd say, look, when you have those kind of processes, or even just, the piece of work we do with yourselves on SAO and looking at various divisions, you know, there's a lot of stuff where it's kind of, you say, well, okay, no tax exposures here, great, but it does kind of just flush out and make you think a bit more around, okay, but there's certain things where you go, are we putting a little bit of blind faith in certain things?
Mm-hmm.
And there is, and I think the challenge you have with all this is also just there's a practical balance. It's if you want the all singing, all dancing, controlled piece, it's you're into a full blown, effectively internal audit
Mm.
function. As I said, like we are on that journey more generally as a group, but it requires resources, it requires time, and depending on the size and scale of your business, you know, not everyone is going to be there. But I think, look, again, it's back to this kind of whole area of, look, any controls you have are reasonable controls or proportionate to the
Yeah,
size and scale of your business. So I think that's always to be borne in mind as well,
yeah, yeah,
in terms of how you do this.
yeah. Okay, thank you so much, Shane, for sharing your insights and your role in the years at the business. That's really helpful, and I think lots of businesses on the call today will have really valued that practical insight. So thank you very much. Simon, we have Simon Wood joining us.
Tough act to follow. I'll try and keep it brief, given we've got 4 minutes. Go for it.
Great. So Simon,
Okay.
thank you for joining us today. So Simon, you joined BDO recently from HMRC, and you were involved in the development of the transfer pricing guidelines for compliance. I'm sure there's a lot of questions on this, but I guess linking back to some of the content earlier around the business risk review, it'd be great to get your insight into whether you think the guidelines for compliance will start to feature in HMRC's business risk review moving forwards.
Yeah, all right. Thanks, Martin. Yeah. Well, like Karen mentioned, CCMs have actually already been pointing out the TP and VAT ones in particular to large businesses. So be surprised if they're not going to follow up, like, to some extent, to see what you've made of them. But I think it will depend on the group and your relevant risks. But in what I do, if you think about a group of complex TP or TP HMRC doesn't yet understand, I think it's going to feature at least behind the scenes. And to that point, the manuals have been updated already, pointing inspectors at the TP GFC to say, use this when identifying TP risks, because there's defined high risk indicators in there. And I also think the VAT and TP ones are so fundamental. I don't think they're just going to feature in BRRs, but I think they're actually going to really influence the BRRs. You see what I mean?
Right. Okay. I mean, that's really helpful, Simon. And I guess, ultimately, you were involved in the transfer pricing guideline development, but how straightforward or challenging do you think it will be for businesses to actually sort of implement those expectations under the guidelines for compliance?
Yeah, really challenging. Let's not forget, it is a set of ideals. It's gold standard, right? So it's not going to be right for everyone to adopt all that. But just given the volume, just reading it, like digesting it, pinpointing the relevant stuff to you, that's hard work alone, right? So I think the first question is, do you actually want to respond? Because ultimately all that matters is being compliant. And how you get there is always a business choice. So some groups are just going to continue as they are, right? But the approach does matter, though, if you get it wrong, if there's an adjustment. So if there's an adjustment, then HMRC will look at, well, was that a mistake despite taking reasonable care? And they'll have to assess your behaviours, and there'll be certain questions they go through as part of that. So some people might want to preempt that. So if you're doing that, I'd probably focus on any of your high risk positions, take like a risk-based approach and build up your evidence base for those first and foremost. There might also be some straightforward process and like control stuff that's teed up in the guidance, like quick wins in there as well.
And I guess sort of final question from me, Simon, is around do the expectations we sort of talked about today in respect to the business risk review align with your own experience at HMRC, and whether you could provide a bit of insight into that?
Yeah, well, Karen gave the transactional side of it, right? Or it might be you, Martin, I've forgotten, where it was like, this is the standard patterns or risks and processes HMRC are looking to understand. So there'll be a questionnaire element to that. But then your actual experience depends on what you want to get out of it and what HMRC want to get out of it. Like, what's your current relationship and the strength of it? What do you want it to be? What's their objectives or the CCMs and what's yours? And sometimes when I sat in BRIs, it's always helpful if there was some level of presentation, for example. So you might want to think about getting finance involved, maybe to give an update of business performance. It's always a nice touch. And what have the tax team been up to this year? Has there been anything new to alert HMRC to? How have you responded to some past concerns or risks, from the last BRR? So yeah, and you might want to consider sharing documents as well. That's always a business choice. Comes down really to the impression you want to leave and the feelings you want to get across.
Right. So an element of sort of owning the agenda with HMRC certainly is a key takeaway for most people. Karen, I'll pass over to you, conscious of time, just to do the wrap up. Oh, you're on mute, Karen.
Schoolboy error. We've had lots and lots of questions coming through. Thank you. So we've been trying to answer them as we go through. We will open it up. I'm conscious of time there, but we will be here for a little while if anybody does have further questions. But we do just have a poll, which would be super grateful if you could answer for us. So our question is, after hearing the session today, how confident do you feel about your alignment with large business expectations? Really grateful if you could provide your response, please. Just give 30 seconds or so for those answers to come through. Perhaps Natalie, if you just let me know when we've got responses in. But hoping that this session today has been insightful both for those businesses who are growing towards the large business space and the expectations that you might soon find yourselves in. I mean, growing as a business is a great thing, right? But it does come with some additional compliance requirements. And for those who are already in that large business space, hopefully it's helped as a refresher and to just remind of HMRC's high standards and expectations. But thanks so much there. So we've got some results in. I don't think those answers massively surprise me, because I think when I reflect on everything we've talked about today, there are huge expectations on businesses in relation to tax governance. As I said when we started, it's been a growing theme and we don't expect it to change. There are some practical strategies that you can adopt in there, and hopefully some of that today that we've shared has been helpful. If you do have any questions, I can see we've got quite a lot in that middle space of somewhat confident, reasonably confident. Please do feel free to reach out to any of us if you would value a conversation about your business. And at this stage, just like to say thank you so much to everybody for joining. If there are any final questions, please do feel free to pop them in the Q&A function and we'll do our best to answer. And just whilst any final questions might be coming through, James at the start of the session mentioned the upcoming next parts in our series, which we've got in February through to July. So different angles to tax governance, particularly about building that tax operating model and what good looks like, which builds on the session for today. And then a specific session around for private equity backed businesses and tax governance. You heard from Shane there today about the interest that their private equity owner has in tax governance, and certainly has a bit of a different perspective and agenda on that. So that would be useful for any other private equity businesses in due course. And then moving on to automation and effective strategies when HMRC raises queries. Have we got any more questions coming through in the Q&A? We've got a couple there, which we'll just do our best to answer. But otherwise, thank you very much, everybody, for joining us. I think we'll wrap up there. Thank you.